Talk is on, where you receive good information for your mortgage needs, such as mortgage programs and foreclosure programs to help get you out of foreclosure. Stay tuned and hear what's coming your way.
Welcome to Mortgage Talk. Glad to be here with you guys on a Friday. Man, it's happening here in Mortgage Talk land. That's what I'm going to call it. Mortgage Talk land. So it's good to be here with you guys here. We are here streaming nationally throughout the internet. Yes, we are. We are streaming worldwide. And we're streaming through over 200 countries, baby. Just let us come into their neck of the woods to bring them Mortgage Talk. And I'm glad to be a part of what's happening here. Got some good information for you today, and I'm going to share that with you. Want to thank our wonderful viewers and listening audience out there, but we are on the internet radio, so there is no simulcasting with HAP TV or Periscope or Twitch TV. We seem to have a little technical problems with Twitch, but we'll be on Twitch after this broadcast to rebroadcast what we're talking about. But we are simulcasting. Yes, we are. We are simulcasting. We're live on Blog Talk Radio. Happy and proud to be part of the family. And thanking you and yours for joining us here at Blog Talk Radio. And we are also on Speaker.com. So glad to be here on Speaker.com because what they do down there, they demand advertise. Good job. Yes, they do. Down at Speaker.com. And we're glad to be a part of Speaker.com. We also are live on iHeartRadio. We're live on iHeartRadio right now. You can tune into iHeartRadio if that's your favorite listening area that you want to go to. If that's your favorite platform, if that's your favorite directory, then you can get us on iHeartRadio just by keying in our name, Mortgage Talk 1, and that is the number one symbol. We're also on Spotify. What's up, Spotify? What's up? So we're on Spotify. So what's going on there with you? And also on Google Podcasts and Podcast Addict. Yeah, Denzer. We're on that too just as well. And we're also on Apple Podcasts and Podcasts itself and Pod Chaser. Man, we're on Amazon Music too, baby. So on iHeartRadio, love you guys out there. Don't forget to vote Mortgage Talk in for one of your favorite shows that you like and enjoy. We're going to continue to keep our best foot forward. So if you haven't heard of us, you will be hearing of us. We got a lot of blogs out there. Our history is with Blog Talk Radio. You can always go and review our history and review some of the blogs that we have created. Just go to blogtalkradio.com/Mortgage Talk 1, the number one symbol, and key in, and you'll see my picture, which is my face, which is the new show for us for Mortgage Talk. Our symbol is the lighthouse, and so you'll see Mortgage Talk and a lot of our history. You will see the symbol of the lighthouse, but you see my name, Rick Montgomery, on there, and that's me. We're also on Speaker.com, and just download the icon of Speaker.com, and you can go in and type in the search bar Mortgage Talk. Isn't that wonderful? Isn't that beautiful? And you'll get a chance to pick us up. Don't forget Mortgage Talk 1, and you got us at Speaker.com. Don't forget to get that icon. A lot of good stuff is happening at Speaker.com and Blog Talk Radio. So, topic today is Freddie Mac and Fannie Mae conventional 97% loan. Now, this is a loan that is with Freddie Mac and Fannie Mae. The idea came from Fannie Mae. which is a LLC corporation, has nothing to do with the federal government, but just a contract with the federal government. And they are competing against FHA. Now, I'm not one of those brokers that's going to tell you that what I favor. First of all, this is the residential market, and I have 20 years of experience in that residential market, but I don't practice in the residential market. I'm a commercial mortgage broker, and I am an insurance agent. I own my own agency. So I'm tied up in that capacity where I work with small business that may have funds tied up, but they need to have some insurance coverage, whether it's health insurance, whether it's retirement, but they don't have the money, so we can do premium financing to help them and let the policy itself pay for the loan. It's real simple, real easy. And if you're a company that's listening, just call my office to get more information. And you can ask for me directly, Rick Montgomery, at 708-572-7855. 708-572-7855. And I can explain it to you. We'll set up an appointment on virtual so we can see each other, talk with each other, and help you, as I have done many other small businesses, and assist you in that capacity. Because insurance is the key for everything. Even what I'm going to be talking about today on today's topic is everything. So Freddie Mac and Fannie Mae is a conventional loan lender. That means that you have to have conventional loan credit. Yeah. In order for you to qualify. So they came up with this program, what they call conventional 97% loan. Now, I want you to understand a while back, especially in the 70s and 80s and 90s, and up until the fall of the 2008 real estate market, FHA was a 97% guarantee loan investor. That all you needed was 3% to put down. But things changed as times went on, and FHA is a 3.5% down now, in which FHA will bring 96.5% to the closing table. This is not about competing against FHA. This is about giving you options. Yes, indeed. Giving you options that you can have in your arsenal to find the best fit. FHA is not going to be a good fit for everybody. Amen. So conventional 97 may be that fit. And so we're talking about it today to give you some information on it. So conventional 97 is the LTV, another mortgage term, because what Mortgage Talk is all about is about promoting an educated consumer, which is indeed the best customer. And so we're going to give you some mortgage terminologies so you can be familiar with what's happening. So you can stand firm in your square when you're sitting down talking to people about your mortgage or a loan officer. Now is the time. This is the time. This is the time. This is the time for you to get out there and do your purchase. Rate is at an all-time historical low. That's why I'm giving you these programs. Find one that would fit you. We talked about FHA rehab loan. Next week, we're going to talk about FHA loan, period. The one that I mentioned earlier to you. That all you need is 3.5% to put down. And you get a loan amount of 96.5. That's next week. But right now, let me tell you about this good program, which is Fannie Mae 97% conventional loan. Because they're going to bring 97% of the loan to the table. That is your LTV, loan to value. That's 97% of the sale price that they're going to bring to the table, leaving you with 3% to put down plus closing costs. Okay? And you know you can get a 5% gift from the bank of mom and dad, and that can cover your closing costs. Ain't that something? Maybe you may get a gift from the seller because there were some things that you saw that he could have took care of, so he's going to give you a credit toward closing. Got to move on. So with this loan, you can purchase a single-family home, a condominium, a co-op, a PUD. With this loan, you can qualify for that. This program is compared to FHA, as I mentioned earlier, and went over with you. But when you look at the traditional program that Fannie Mae and Freddie Mac has, because this is a conventional loan program, their program require 20% down. And with that 20% down, you got a stake in the game a little stronger, but you don't have to worry about mortgage insurance. Okay? But with this program that they are competing up against, their 97% conventional loan program, you're going to incur PMI. PMI is private mortgage insurance. PMI is what you would pay. But with this program, and I'm going to tell you about that just a tick, 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 tick. But let me just finish this point and tell you what PMI is for those of you who do not know. Private mortgage insurance is what PMI stands for. That's the insurance that you pay monthly out of your promissory note payment. And that is for the lender in case you default. And if you default on the loan, they will get paid. Now, I can go a little bit deeper with that. I certainly can. But this is not the venue for that. So I'm giving you what you just need to know for right now. So with this loan, it will incur a PMI, private mortgage insurance. Unlike FHA that is competing up against, FHA has a requirement credit score of 580 to qualify. Now, you may have to shop it around through other lenders because there are some lenders that will offer you FHA, and simply because they will service the loan, not all of them do it, they will require you to have a credit score between 620 and 640 to qualify for FHA. Conventional 97% Fannie Mae loan requires you to have a minimum score of 620. Now, when you make the comparison between conventional 97% loan, this new program, when you look at the LTV program, it's one of the, they require one of the low down payments as compared to their competitor and FHA loans with no upfront, listen now, with no upfront mortgage insurance. You see, MI is what FHA has. It's the same as PMI. But you will have to pay the first initials of the premium up front before the other is taken out on a monthly basis out of your loan. Now, it's only 1.75% of the loan. and that'll be incurred into your closing costs. Unlike Fannie Mae's conventional 97% loan, there is no upfront fees. One of the comparative difference. Okay? Another comparative difference that FHA used to have, but don't have anymore, is that when you pay the loan over years, and you pay it down from 97% under this loan, and you pay it down to 78% of the loan, or I'm sorry, 79% of the loan was paid, your PMI would drop off automatically. Naturally, you would have to put that request in because you can't depend that they will get it immediately. So you may have to call them and let them know. Okay? With FHA, it used to be like that, but now FHA will hold MI, mortgage insurance, for the duration of the loan. MI is the same as PMI. If you default on a loan, the investor, which is FHA, which is HUD, will get paid 20% of the initial down payment, even though you only put down 3.5% for HUD. Like PMI, you only put down 3% for conventional 97. If you default, the investor will get 20% from the insurance. Unlike with HUD, HUD will sell the property after foreclosure to recover the remaining of the balance that's owed to them. Whereas in the conventional end, there is an insurance that after 90 days, on the 91st day, that insurance policy pays out that whole loan. Okay? I just want to just let you know. That's how it goes. Got to move on. So, what's that? What do that mean to a borrower who will receive the same low rate for 3% down in compared to the conventional borrower that has to put 20% down? Why is it that they would get the same rate? Well, that's what they would do. FHA has the same thing. That's what they would happen. So they guarantee you the lowest rate possible out there. Of course, it's a premeditated on your score, but you will get the lowest rate possible. And that low rate is indeed in conjunction with a person that put 20% down. That's the meat and the potatoes to this program. Same thing with FHA. You get the lowest rate out there. Even if you got challenged credit, you will come out with a low rate guaranteed under FHA and also guaranteed under Freddie Mac and Fannie Mae 97% loan. Okay? Moving on. Under the conventional loan that Fannie Mae and Freddie Mac has, and when their borrower puts down 20% and 80% of the loan is what he's going to be carrying back in form of a mortgage, his credit scores have to be within a 660 range. Okay? It has to be like 660 to qualify. Now, when you look at the 80% of the LTV used for the loan amount with a credit score of 660 on a traditional conventional loan, you will receive a rate estimate increase of, let's say, no, not a rate increase, but you will receive a rate increase of about 3/8 of 1% because of the credit score. 650 is considered a low score. At one time, it used to be a very good high score, but it is considered a low score. Keep in mind, all three of the bureaus will be pulled, and they're looking for the middle score to qualify. Okay? Because of the fact that PMI was added to the kitty with this program, it took away some of the risks. It just took some of the risks off. Fannie Mae, your investor, when designing this program mimicking FHA some, but they designed the program so it can be attractive enough for lenders to want to come aboard. Because even though Fannie Mae and Freddie Mac is going to loan the money out, they're going to become the servicer to the loan, not the investor. Because the investor is Fannie Mae and Freddie Mac. They're their investor. They're the ones that's giving the guarantee that if you default, we're going to make sure you, Mr. Banker, get paid. Plus your late fees and attorney fees, you're going to get paid with no hesitation or anything on our part to pay you. You will get paid. We guarantee that. And that gives the lender a comfort zone, because now I can take a chance with people that have low scores, like a 660. And I can take that chance on them. It makes it a much sellable package when it's done that way. Okay? So remember, Fannie Mae, Freddie Mac, they are the investor. The lender who present the money at the table will wind up being your servicer. And if they sell off the loan, they'll sell off the loan to another bank or credit union that will be your new servicer, not your lender. Your investor under this program is Freddie Mac and Fannie Mae. They are your investor. Remember that. If the borrower defaults, as I mentioned, on that mortgage, the mortgage insurance company will reimburse the investor of the mortgage, of the one that holds the mortgage, that holds the deed, and holds the promissory note, will receive 20% of the loan they will get that, period. They'll just get the 20% of that, and they can recuperate the rest of their money through the foreclosure procedures of the selling off of a home. Now, got to move on. Happen to know that they're going to get something else, but again, that's a horse of another color, so let me move on. The investor, because you don't have a crystal ball, you don't know if you're going to go into foreclosure or not. Most people go into foreclosure because of job-related incidents. Maybe they got laid off. Maybe they got cut in salary. Maybe got shifted to a different department that pays less. Okay? So people do not plan to go in foreclosure. They just fail to plan not to. So they don't take out mortgage protection insurance. If they had because you had to get homeowners insurance, so you should have looked at mortgage protection insurance too. Because if something were to happen to you, your house is protected. Your family will not get put out. And if you set the term correctly, the house will be paid for if something were to happen to you. And your loved one will receive the revenue funds from your policy that will give them protection, help them cover some bills, and they'll be in good shape. Got to move on. So mortgage protection insurance is one that is highly recommended to homeowners to obtain. All you have to do is just contact my office at 708-572-7855, 708-572-7855. Get your free booklet sent out to you. We'll go over with you. If you have any concern questions, we will answer those questions right here in my office at MCC Financial Service. But we'll send it out to you, and all you have to do is just make the call, leave your information, leave your name, address, phone number, and that's it. And we will return your call. That's how easy that this is. Many of today's home buyers will meet and can meet the guidelines set forth by Fannie Mae. 97% of the loan, a lot of them will meet the guidelines because the guidelines are broken down and really simple. So the guidelines for this new loan options is that the mortgage will be a fixed rate. The mortgage will be a fixed rate. No adjustable rates. No arm rate. It will be a fixed rate. The property is must be a one-unit family home, single-family home, or a co-op, or a pub, or a condominium. At least one buyer, if there's two buyers, at least one buyer has not owned a home in the last 3 years. So if it's two of you out there, make sure that neither one of you has experienced a bankruptcy. Okay? Got to move on. The property will be the owner's primary residence. And you will sign that form at the closing table. You agree that this will be your primary residence. You agree to that. At least one buyer has not owned a home in the last 3 years. I missed that earlier, but I want to bring that home again. The property will be the owner's primary residence. The loan amount is at our below $548,250. The loan must be below that. That is the max of the LTV of the loan that you can receive under the Fannie Mae and Freddie Mac conventional loan program. In comparison to that to FHA, FHA has the higher loan amount. And theirs is in 800. I think it's 860. So you have the highest. Now these features align well with the typical first-time home buyer programs. Most first-time buyers are looking for single-family homes, condominiums. Some of them are even looking for duplex. Now, according to Fannie Mae loan level price adjustment, which is LLCPA, Fannie Mae's loan level price adjustment, the chart, a borrower can have a score as low as 620, as I mentioned earlier, to qualify for this particular loan. $620. The average score for a traditional conditional loan is usually 620, 640 through 660 or more. But the average credit score, I'm sorry, I missed saying that the other time. The average credit score must fall within the range of 640 to 660. Now, mortgage rates for the 3% down program of Fannie Mae programs are based on the standard that Fannie Mae rates plus a slight rate increase, just a tick rate increase. But these loans will come with rates only about 1/8 to 1/4, only about 1/8 to 1/4 of the 1% higher than the mortgage available to the borrower, putting 5 to 10% as a down payment. But these loans come with rates only about 1/8 to 1/4 of 1% higher than the rates that's available to borrowers, from 5 to 10% qualifying as down. The buyer buying a $250,000 home, which is like the average cost for today, would pay about $60 more per month by choosing the 97% loan compared to FHA, or even compared to the other conventional loan that requires 5% down. So they want to get it out of the way. The buyer reduced the total upfront income by buying the costs that's slightly over $5,000. By the time you save, the extra 2% down could mean higher home prices and tough qualifying down the road. In other words, now's the best time to buy. And those of you should not be out here if you're not serious enough about buying. And when you become serious enough in buying, you only need to see maybe 3 to 4 houses so you can narrow it down, and that's it. And your persona that you have has to be exciting enough because you're about to get a home. You went to go get approved. You about to get a slice of the American dream. Wow. Now, I got some questions for you that was sent to me through our Mortgage Talk Facebook page. And I chose some of the questions and incorporated into the show where I'm going to answer the questions. But I want to just close out this meaning, that when a buyer reduces their total upfront home buying costs by over 5%, wow, that's a big savings on this loan. By the time you save that extra 2% down, the industry has did a change. Or high prices is out here that would draw up the price. So be aware that you're not the only one looking for this home. So you need to put on your serious hat if you're trying to be serious on purchasing a home. Put on your serious hat, leave the kids at home. So there's no distraction for you when you're doing your walkthrough. There's no distraction. And because you're aware that when you come to purchase a home, you don't want to bring a bunch of kids with you. Now, it's good for you to bring the kids with you if you're shopping first and you find a home and you stop in there and you inquire and you pick up some information on it, but you're going to get back with the realtor either through your own realtor or through a realtor that works out of the office in which the listing realtor is at. That's your call. That's your choice. Just remember that this program is a program that you can qualify for. It is a program on the conventional loan level, like no other conventional loan program out there. This is the real deal. Got to move on. Here are some of the questions. Can the buyer buy a condominium or townhouse with this conventional 97% loan? Answer to that question is yes. The buyer can purchase a condo, townhome, a house co-op, and they can purchase any one of these as long as it is only a one or considered a one unit. Okay? Got to move on. Next question. Here, I have a concern question. I own a home for 2 years, but have been renting since will I qualify? I own a home for 2 years. She doesn't say what happens to the home. Obviously, there's a little time between it. And so her question was, will I qualify? And the answer is not yet. The answer is not yet. You must wait until at least 3 years have passed since you had any ownership in an resident at that point in time. You have to wait 3 years before you can even apply. Okay? It's not a penalization. It just, you will have to put some space time between the last time that you applied. Okay? Here's a concern question. Can I get a conforming jumbo loan with this program and gain that 3% down? No, you cannot do that. There are loan limits for this program. At this time, the high balance, also known as conforming jumbo loan, these that are over, any loan that's over $548,250 are not eligible. So, in other words, if you go out there and find a $550,000 house and you're selling it for that amount, and the total amount, $550,250, is what they closing on, you won't be able to get that loan because you won't be able to make it to the closing because it's went over the maximum loan amount. Now, when you make the comparison between that to an FHA, you find that FHA has over $860,000 that you can qualify for with just that 3% down. Now, that seems to be more feasible. Because if this particular person is looking for a home that's going to cost $600,000, they may want to look at FHA because conventional 97 is not going to be a good fit for that program. I've been approved. So when you look at this overall, this particular person will do better by going to FHA and qualify for their home because of the large dollar amount. They'll still qualify because remember, FHA limit is over $860,000. So with that means that jumbo loan client can easily fit into this program and purchase the home of his dreams or purchase a home of his dreams. He can do that. He can do that. Now, I've been approved putting 5% down on a conventional loan, but I like to make that change over to that 3% down instead. Can I do that? Answer to that question is yes, you can. Yes, you're on a conventional loan. You got qualified to put down 5%. You looked around and said, you know what? I like that 3% program. I wish I was told about that earlier because I would have chosen. Whoa. I don't want that 5%. I want that 3%. Can I do it? Yes, you can. But what's going to happen is that the underwriter is going to have to re-underwrite the loan again. So keep in mind that your DTI will be coming in use again. Now, mind you that the DTI ratio will rise with the higher loan amount. So when they re-underwrite this thing, because you're applying for it because of the large amount of loan that they can give, and so you determine that the 97% conventional Freddie Mac and Fannie Mae loan is just not meeting your goals. Well then you can get this loan, conventional 97%. But just know that when you switching over from putting that 5% down to put down that 3%, what you should notice that your DTI will be taken into account. Your debt ratio will be taken into account. So just keep that in mind. But yeah, you can switch over from a conventional style loan to the 3% down loan. That is not an issue. That is not a problem. And yes, you will be able to do that. But note that the rate may go up by a quarter of a point because of the dollar amount. And also note that the debt ratio concept could be reduced or it could go up for you. One of the two. Okay? So, with that said, what I want to do here is thank you guys for you guys listening in and tuning in, because we are doing a simulcast show with Speaker.com and with Blog Talk Radio. Now this conventional loan, as I was mentioning, is an optional. So, but they are competing up against FHA, but it's optional. And the optional concept, meaning that it's just a program that you can consider. What I want you to do is just go to Fannie Mae and Freddie Mac's website and just type in there, conventional 97% loan. Learn more, and then learn how you can qualify. With a 620 score, you can qualify. And with a lower DTI, debt to income ratio, you can qualify and only put 3% down plus the closing costs and bring 97% to the table. That's good for a conventional loan, especially during the pandemic time. Who has the 20% to put down, and who really wants to put 20% down? Especially during this time. But again, you may not be feeling FHA. But this conventional could be what you're feeling. Freddie Mac and Fannie Mae's conventional 97% loan allows you to put only 3% down, and they're going to bring 97% of the loan to the table of the sale price for you to get, and this is a conventional loan. Wow. Talking about give you an opportunity. There it is right there. Well, that's it for me for Mortgage Talk. I appreciate you tuning in, and I appreciate you being here. So, to our listeners from Blog Talk Radio, we are signing off, and we'll be back. And to our listeners at Speaker.com, good night, everybody.
Thank you for listening to Mortgage Talk I hope this information is something that you can use for your mortgage needs. Remember to tune in next week at the same time for more mortgage talk. God bless you.
That you've done for me. I want to thank you for taking good care of me. Thank you for all that you mean to me. Now